Welcome back to our Stock Academy. In our last session, we explored the birth of a stock market with the tale of the Dutch East India Company and followed Tom's journey from a small pizza stall to bustling stock exchange. Today, we're going deeper into the essence of what it means to own a stock in a company, the difference between common and preferred stock, and why businesses opt to share pieces of their future with investors like you. First, let's start with what stocks represent in a company. Imagine you loved Tom's Pizza so much that you wanted a permanent piece of it. Not just the pizza, but a slice of the business itself. That's essentially what buying a stock is, acquiring a piece of a company. If you buy Tom's stocks, you become one of the owners, entitled to the share of the profits through dividend, and depending on the type of stock, a say in how the business is run. The commonly traded stocks of a company are called common stocks, but some stocks can have certain advantage, which are called preferred stocks. Let's understand what are common and preferred stocks. As Tom's business flourished, he decided to issue two types of stock, common and preferred. Each type caters to different investor needs and offers distinct benefits and risk. Tom's common stocks are like the base layer of his pizza, essential and foundational. Shareholders get voting rights, meaning they can vote on important company decisions, including who manages the business. They also stand to gain dividends, which are a share of the profit, although these dividends aren't guaranteed and can fluctuate. However, they do come with a risk. If the business fails, common shareholders are the last to be paid, after creditors and preferred shareholders. On the other hand, preferred stocks are like adding a special topping on your slice of pizza. These stocks don't usually grant voting rights, but they offer a fixed dividend, making them similar to receiving a consistent recipe of returns. Preferred shareholders are higher in line than common shareholders if the business goes under. They get their share from a remaining assets sooner compared to common stocks. Now let's come to the final part of this video, which is why companies issue stocks. Throwing light on the story of Tom again, Tom's decision to issue stocks wasn't made lightly. He needed capital to expand beyond Bangalore into cities like Mumbai and Delhi. When a company needs capital to expand or to fulfill its regular needs, it can either go for debt financing or equity financing. Debt financing means issuing bonds or promising the payer that they will return back the principal with interest at a predefined date. Financially, this is similar to taking a loan, as they will be bound to pay the interest along with the principal. Equity financing is selling a part of ownership of the business in return for cash. Shareholders will get benefits if the business makes profit, as the value of the shares will increase. Later on, the shareholders can sell their shares to book the profit. Apart from this, companies can offer dividends to their shareholders as a share of their profit. But there is a catch here. The value of each stock can increase, but it can also decrease if the company fails to perform well in their industry. And this is where the risk of investing in stock market comes up. In our story of Tom, issuing stocks provided him with the necessary funds without the burden of debt or loan interest. It also allowed him to share the financial risk with others passionate about his business. Moreover, being listed on a stock exchange boosted Tom's public image, attracting more customers and investors alike, thereby increasing the overall value of his pizza empire. But at some point in time, if people find other pizza stalls better, then the stocks of Tom Pizza Company will go down and investors will bear the losses. But this is not the only reason why the stocks of a particular company go up or down in value and what impacts it can have on the economy. We will be learning about it and a lot more on the stock market. Stay tuned for more insights into the bustling world of stocks. Investments in securities market are subject to market risk. Read all the related documents carefully before investing.